Give us a sense of where you're seeing the market headed, given now that we've almost wrapped up the Q1 earnings season. Do you believe valuations look comfortable given the kind of consolidation we've seen and some pockets where you've seen some good moves coming in over the course of the earnings?
Sure. Thanks for having me on the show. I think the last 6-7 months have been quite interesting overall for the market. There have a lot of macro events that have played out both domestically as well as globally. And we have not actually seen the impact of those on real underlying economic data fully yet. So I think next 2 months are going to be crucial from that point of view. So if you look at the jobs data in the US, the inflation data in the US, how does that start to reflect all the tariff increases that have happened since beginning of the year? And the US currency has also depreciated meaningfully, almost about 10% since beginning of the year. So I think that will really lay the foundation for what the second half will look like in terms of flows to various markets. Year to date, actually, India has been much weaker compared to global markets. So the dollar weakness has really driven a major rally across most markets. So most emerging markets in as well as in Europe, markets are up almost 20 to 30% year to date. India has underperformed that. But I think if we continue to see a dollar weakness continue, I think you will start to see flows towards India also turn positive. What's been lackluster, as you mentioned, has been the earnings. So the aggregate earnings continue to come out. Earnings growth is continuing to come out at about 7-8%. And we haven't seen a pickup yet. I think the big hope is that in second half, on back of good monsoon, better liquidity, lower rates, we start to see better numbers coming out in the second half. And as you know, the base of earnings in the second half is also lower. So I think that's really the big expectation going into the second half, that we start to see some pickup coming through.
Mansi, this side, yes, it has been challenging times as we see, but don't you think it is a blessing in disguise and a dip, an opportunity to enter the market? How should one devise a strategy? Because if we see the latest AMFI data, it clearly explains the conviction that the market participants have in the equity market. SIP flows increased to an all-time high of 28,464. What are the sectors on your radar at present?
Sure. So let me address the two differently. So I think one, we are talking about the flows per se. Yes, it's been very heartening that domestic flows continue to be very strong. And if you look at FII flows, they actually continue to be very volatile. So in April to June, we saw about $4 billion of inflow, and we actually have seen about $4 billion outflow over the last 45 days or so. But I think what has also weighed on the market is the fact that even as domestic flows have continued to be strong, we continue to see a lot of supply in the market, both in the secondary market as well as the IPO pipeline. And while we get, and if you look last month, we had about $6 billion of flows into mutual funds. But over the last 3 months, there has been almost $21-22 billion of supply in the market. So I think those factors kind of balance each other out. I think we need to focus on the underlying companies and sectors that are delivering better earnings and earnings growth. We are focused on a few sectors like financial, and in financials we are overweight in BFCs. We believe the RBI policy and the liquidity boost that's come through will start reflecting both in terms of better margins as well as growth for the NBFC sector. We like the consumer discretionary space as well. In particular, segments like retailing, quick commerce. We are also overweight select capital goods and power sector plays.
All right. Hi, Ashish. This is Shrishti, but I believe that you have reduced your overweight stance on the automobile sector. But Of late, Ashish, that sector is once again seeing a resurgence, maybe because of the back of a bit of an optimism building in with respect to the festive demand, suppressed valuations as well, since select counters have corrected from their all-time highs. What's your take on the automobile sector? Will you be willing to track a couple of these monthly data numbers? Are you building hopes on that sector, or rather believe that the kind of a weakness we have seen in the numbers, especially from the passenger vehicle space, that is here to persist?
So actually, more than passenger vehicle, we have seen some uptick in demand in the two-wheeler side. I think the passenger vehicle market continues to remain fairly soft. We have positions only in a couple of companies that are actually demonstrating good market share gains. But on the broader sector, we actually believe that the demand revival is still not visible. In fact, inventory levels across the industry have actually gone up even well ahead of the festive season. So generally, you see manufacturers build up inventory in the months, just a couple of months before the festive season, but already I think inventory levels are fairly high in the system. So we, as you mentioned, have reduced weight in the sector. The other piece also has been that on the component side, given how the demand for major manufacturers, OEMs internationally, particularly the European players, has been, the outlook for growth there also has moderated. So we have actually reduced exposure both on the OEM space as well as the auto component.
Ashish, while we're talking about consumption, while we're talking about autos, want to get your sense on the overall consumption. Now, based on quarter one earnings, it did seem like staples are trying to find its footing once again. But what is your sense of the broader consumption themes in terms of discretionary consumption, leisure, travel and tourism, entertainment, or high-end retail? What is your take on all of that? Do you believe that these sectors could outperform the traditional staples, and that is a trend that we have recently seen building? Do you think that could sustain going ahead?
Sure. So actually, if we divide consumption into three buckets, one is really mass mass consumption, which is, as you mentioned, demonstrated probably in the FMCG numbers, and then at the other end of the spectrum is high-end consumption, which is travel, leisure. And then in the middle, there is, let's say, middle income consumption, urban consumption. So if we see both the top end of the consumption has been doing well for the last 3 years and continues to do well. And that's reflected in our portfolios. What's changed in the last 3 quarters is that mass consumption, rural consumption on back of strong agri income over the last 3 quarters has picked up. And actually, rural consumption is now doing better than urban consumption. But the middle bucket of consumption actually continues to be slack. And I think that's the revival we are keenly awaiting, if there are any signs of that through the festive season. But I think that is a big driver of overall consumer space. And that, as of now, continues to lag.
One last thing I would want to ask you. as we see the factors which are helping the market, and on the contrary, the factors which are not being able to give a proper direction to the markets. To start with the positives first, the capex and tech's momentum trend is strong. We also see manufacturing and service activity being robust, but cannot negate the fact that the FIs are not making a comeback in the market. I sometimes feel they are missing an opportunity also to enter a market which is an emerging market like India. However, we also did see the result season, the first half of which was weak. According to you, what is a major factor, a trigger which can give one direction to the market next?
So I think it simply has to be a better earnings growth. So I think as we have seen over the last 12 months, nominal GDP growth slow down from double digit to single digit. It has kind of weighed down on corporate top line growth and corporate earnings. So if I aggregate corporate earnings growth is only 7-8%, it is not an exciting enough market for foreign investors. So I think what we need to do is demonstrate going back into double-digit earnings growth. Yes, there are select sectors in the economy, select companies that are growing still growing earnings about 15-20%, but that is only about 23-24% of the total cohort. So I think we need a broader pickup in earnings growth.
All right, but Ashish, with this we let you go on that. Thank you so much for taking the time out and speaking with us and helping us with your take on the markets.